So, Mike, what are the benefits of an EOT?
Really, in short, it's get full value for your business, preserve your legacy, and do it in a tax-free environment. That's basically the highlights and the summary of what an EOT is.
Okay, so Richard, a bit more context on what actually is an EOT.
An EOT is a form of trust which the business owner will sell their shares to, and instead of selling to individual employees, so everybody's got a little shareholding, they sell to an employee ownership trust, who then takes care of the beneficiaries who are the employees of the business. So that's what an EOT actually is. The benefits of using one are that it effectively gives the owner a capital gains tax exemption on selling, provided the EOT ends up with a controlling shareholding.
Okay, so I mean, it sounds like there's a lot of benefits for business owners who want to exit their business and looking for ways out. So how well would you say EOTs are known? Are they kind of is it a widely used exit strategy?
Not as wide as it should be, I don't think.
I agree. I think it's probably one of the best kept secrets that HMRC have in their arsenal of tax planning. I think there's maybe a couple of thousand EOTs is the reality. Certainly 2 years ago, the last data we had available, there was only about 1,100. That's absolutely not the right answer. Now, doing a trade sale is a fantastic way of destroying your legacy. Doing an EOT preserves your legacy, keeps everybody intact in the business, and gives you that full value still. So why would you not do it? That's the bit I don't get. Why would you not do it? And you don't do it because you just don't know about it. So HMRC's role is supposed to be 50% governance and 50% marketing, but they don't have the resource for that. So they're basically 99.99% governance, and they forget about the 100% that should be marketing.
And they leave it to people like us.
They leave it to people like us.
So what are the kind of, markers of a suitable business who should be looking at this as an exit strategy?
Well, for me, it's every single business owner who is thinking about an exit should be considering an EOT in their process. I mean, you've got broadly trade sale, management buyout of some description, whether that's combined with a bit of trade sale as well, or sell it to your employees. So those are kind of your three options. Pretty much every business owner I talk to about exit strategy talks about trade sale or an MBO. Nobody talks about EOT. Nobody that I've spoken to in the last 3 months, maybe a dozen business owners considering exit, didn't know anything about EOT.
So having been through the process, what prevented you from selling?
Me personally, what prevented me from selling?
Yeah.
So we did this 18 months ago. The biggest thing for me was, could I get a substantial value in a trade sale? Yes, I could. Would I be able to look a member of staff in the eye 18 months later, as I climb out of my brand new Aston Martin, thank you very much, they still haven't found a job yet from when they were made redundant? I don't think I could do that. I don't think I could do that. I know I couldn't do that. It was the wrong thing to do. So the right thing to do is to put the business into the hands of the people who have generated the value. That feels the right thing to do.
Okay, and Richard, you mentioned about the kind of tax benefits that come with choosing to become an EOT. Is this can it be compared to a get-rich-quick scheme, or is that kind of too simplistic and there's more to it?
I think the best way of looking at it is a get-rich-slow scheme. Okay, so the tax breaks are an exemption for the business owner or owners who are disposing of their shares to the trust. And depending on how much cash there is sat in the business when that happens, they will have effectively lent that money to the business and to the trust. So they will get repaid when the business generates cash and profits. Okay. As far as the employees are concerned, there is a £3,600 tax-free bonus that can come out of the EOT structure annually, which is tax-free, and that's the main benefit for employees. There's also the wonderful day sometime in the future called Financial Freedom Day, which is where the loan has been repaid, the founder has been paid off completely, and then that opens up even more benefits to the employees in terms of what's available to distribute.
Okay, and presumably the kind of numbers in the business make a big difference here. So profitability and kind of like how strong the position is of the company.
Absolutely, yeah. So you want to be a profitable business. Yeah, you also want to be a cash generating business. Yeah, because both of those things will lend themselves into it being successful for everybody. Anything more?
I was going to a slight nuance on that. Is it a get-rich-quick scheme? No. I don't think it's a get-rich-slower scheme. I think it's a get-rich-quick as fast as you would any other way. Your reality with an MBO is they're not going to pay you everything on the nose because they won't be able to afford to do that unless you've got a management team that have got a significant amount of money behind them. Or you put a massive debt into the business, which the management team aren't going to like a huge interest charge. If you're doing a trade sale, if you want all of your money on completion, then expect a significant decrease in the value of your company, because now you're pushing all the risk onto the purchaser. So most trade sales that I see will say, at best you'll get a third on completion, third on year one, and a third on year two. That's for a smaller trade sale. If you're selling into a much bigger entity, you may end up with 40% on the nose and 60% in shares in their company, which you're not allowed to sell for 5 years. So I think the quickest you can get your money in any form would be 3 years. If you're doing a trade sale to a bigger corporate, it's probably 7 or 8 years. In an EOT, it's probably about the same. It's probably 6, 7, 8 years, depending on the performance of the business. So I don't think you get in no scenario do you get rich quick unless you're prepared to take a very significant haircut basically on the value of your business, which most people aren't.
Okay. And are there different ways of drawing money out of the business? So can you take money out immediately, or do you have to wait for a certain period of time?
It depends on the balance sheet of the business at the time. Yeah, if you've got accumulated cash, then that can speed up that process of the number of years it takes to pay you back. So that is that's a significant benefit if you're in that situation. So that's getting rich slightly quicker.
So we're looking at a client at the moment, obviously no names, but they have a couple of £1 million cash on their balance sheet because the owners didn't want to be paying out large sums to themselves as dividends and taking a 40-45% tax cut on the way through. So they have a huge slug of cash on the balance sheet, which is probably half the valuation of their business. So on day one, they can get 50% of the money straight away.
Okay, so they're an example of a company that's in a good position.
They're in a great position to do
this. Yeah. Okay, and then so you're kind of talking about how you can preserve the jobs of your people and the kind of culture you've built and all of that side of things. So on the kind of other side of that, for the owner of the business, how much control are they giving up in making this decision and moving across to an EOT?
Yeah, well, on the face of it, technically they're giving up control. Yeah, they are no longer the controlling shareholder of the business. That's the EOT. But in terms of how that then plays out in the years that follow, depends on other bits of the structure, doesn't it? Yeah.
It does, and there's quite a few considerations here. What you're not going to hear us talk about is all of the legal documentation that goes along with this. There's probably a dozen legal documents in this process to make it happen. It's really important to get those right, but once you've got them right, you basically file them away because they're done. But one of the key things in there is how the business owner will get their money. So it's really important to structure that in there in such a way that protects the business owner. You've got to protect the business as well, but there's a happy medium between the two. So in terms of control, yes, you have to give away control. So you're no longer the controlling shareholders. You can't just dip into the company as your own personal piggy bank if you need the money. You can't do that anymore. What you have to do is you have to get the company in a position where it can pay the money and it can pay it according to the legal documentation. So where you had control before, now you have significant influence. And one of the things is, you can control the board effectively, but you can't control the trust board. That has to be independent. So what you need is a really strong, capable, independent trustee, because you end up with 2 directors from the business, typically, one of which is the owner. You end up with 2 employees, you have deadlock. So you have an independent trustee who sits in the middle, who makes the best decision for the only entity that doesn't have a voice, the limited company. So what's the best thing for the limited company? If it is to make that payment, great. If it's not, then it doesn't happen. So it's down to your independent trustee. So picking them, getting the right person is really key to this, because that's how the business owner can continue to have significant influence without having control.
Okay, and so you're giving up that element of control. Is it then possible for the owners to retain some shareholding? And what kind of impact would that have on the EOT?
Absolutely, they can retain a shareholding. The impact on that on the EOT is whatever that percentage is will go to those shareholders when you come to a distribution. More importantly, it dilutes what the employees will end up with. But for business owners, they, particularly if we're talking about legacy and something they've built up, then retaining an ownership is a good thing.
It is. I mean, for me, the other really important thing is if you as a business owner basically divest all of your shares, what message are you sending to your employees, to your customers, your suppliers? You're basically saying, I'm out of here because I've sold everything. If you retain an interest, and it needs to be significant enough, so 10%, something like that, you said to your employees, I'm still here, I'm still invested in the business. And it says the same to your customers and your suppliers. So I think that one of the major points of an EOT is protecting your legacy. You've got to take responsibility for that by making sure that you retain a bit of skin in the game, effectively.
Okay, and then so thinking about the point of protecting your legacy, what's the kind of impact or effect that you've seen on businesses in terms of their performance and kind of motivation of employees once that change is made and once they are or might see themselves as kind of owners of the business?
There's a lot of data out there that says that pretty much as soon as you do an EOT, you get an uplift in performance. So what we find in our business and what we found in the clients that we've helped through this is 2 things really. One is change becomes much easier. So change for change's sake, never a good thing, but change is, for a positive reason to get more efficiency, to get more value out of things, are really easy to do because people want the extra value because it means they get extra value themselves. The other thing it really does is drives accountability. So, individuals within the business will hold each other to account because they will be letting us down if they don't do their role. Now, what the important thing is there is to police it. It's not to, somebody not doing exactly as they should. It's not to pillory that person. It is to kind of go, how can I help? How can I get you to be in the same position as your other team members? How can I help you address the difficulties you're facing in whatever it happens to be in order to get your performance up to the right level?
Yeah.
So it's really important to police it so you get that positive accountability.
So as somebody who's not a business owner who's done this, but on the other side of it, it's definitely a game changer for me coming into this business, in terms of how interested am I, as I always should have been, but how interested am I in you succeeding, in my colleagues succeeding, if other departments succeeding. All of a sudden it becomes a very live, how can I help? The other thing that is very key in all of this, and isn't always said, is about recruitment. It is a game changer in terms of how we recruit, and it's another level of, and by the way, we are employee owned, and that will add a level, I think, of attraction to recruitment.
Okay. And what would you say is one or some of the biggest misconceptions around EOTs and some of the beliefs?
It's too good to be true, I think. I'm sure some of the conversations you've had have been, you could do a trade sale, you could do an MBO, and there's this third option. And they say, sorry, run that past me again.
Yeah. And it's interesting, we've had that from where we've talked to employee groups, that business owners are doing it with their employees. They've asked us to give the presentation. So explain what an EOT is. And that's normally the first question. This sounds too good to be true. Why would anybody want to do this? Well, HMRC want to do it because they know it preserves the legacy. So the business will continue paying VAT. It will continue employing all the people it does now. So it will keep paying PAY and NI and employers NI. The business performance will probably improve, which means they pay more corporation tax. So that legacy basically creates a tax-based legacy for HMRC, where they know that, a trade sale, pretty much all of your overheads are going to disappear in the first 6 months. So salespeople, marketing people, administration, offices are all going to disappear pretty much, because they'll be duplicated. And then they'll look at operational people and say, actually, we've got 2 heads of departments, we only need 1. We've got 6 operative staff. We think with our efficiencies, we can do it with 4. So you pretty much decimate a business. You take maybe 50% of the employees out over the first 2 years. So PAYE, NI, employers NI will disappear. A much bigger corporation will likely have different tax strategies. So they may not be paying any corporation tax at all. So all of that disappears. So from HMRC, they create a tax legacy basically in that business when it stays together. So for them, it's not too good to be true. Basically, they're keeping all of their tax intact, when all they're doing is they're going to delay their capital gains tax. Because if the business is ever sold down the line, then they get the capital gains tax down there. So they get all the taxes now and the tax they think they may have missed out on as well. So they get all of their tax takes.
So that's an important point, is that they do get their capital gains tax down the line, but not from the business owner. They will get it from the trust, the EOT.